A stock pays you 8% a year. Sounds great. Then the dividend gets cut. The stock drops 40%, and you've lost more than you ever collected. That's the dividend trap. And most income investors walk right into it. In the next 7 minutes, I'm going to show you exactly why and what the data says you should be looking for instead. Here's the problem. Most investors search for the highest yield they can find. The logic seems sound. More income, right? But yield is a backward-looking number. It tells you what a company paid, not what it can afford to pay next quarter. In 2020, over 60 S&P 500 companies slashed or suspended their dividends. Some had yields above 6% just months before. Disney, Boeing, Ford, all cut. All had investors who thought they were holding reliable income. So what's the right framework? 5 things. Let me walk through each one. A dividend is only as good as the business behind it. That starts with one number, the payout ratio. Payout ratio is dividends paid on earnings per share. A company paying out 90% of earnings has almost no room for error. One bad quarter and the dividend is at risk. The data shows companies with payout ratios below 60% cut dividends far less frequently over 10-year periods. Johnson & Johnson, Procter & Gamble. These companies have raised dividends for over 50 consecutive years. Their payout ratios consistently in the 40–60% range. Earnings can be managed. Free cash flow is harder to fake. Free cash flow equals operating cash flow minus capital expenditure. If a company generates $5 per share in free cash flow and pays a $1 dividend, the dividend is well covered. If free cash flow is negative and they're still paying dividends, they're borrowing to pay you. That's not income, that's debt. AT&T did this for years. Attractive yield, massive debt load. Eventually, the dividend was cut in half. Coca-Cola has raised its dividend for 62 consecutive years, not because it's exciting, because it generates consistent free cash flow from a global brand with pricing power. AT&T, by contrast, looked like an income stock, yield above 7% at its peak, but the business was consuming cash on acquisitions and infrastructure. The math didn't work. The yield looked great on a screener. The fundamentals told a different story. 3 numbers to check before you trust any dividend. Free cash flow, payout ratio. Look for under 70%, 5. A year dividend growth rate, consistency beats size. Net debt to EBITDA above 3x is a warning sign. Sources TKR.com, macrotrends.net, or any SEC filing under cash flow statement. Takes under 10 minutes per stock once you know where to look. The most common mistake, sorting by yield and buying the top 5 results. A high yield often means the market is pricing in risk. If everyone else is avoiding that stock, there's usually a reason. The second mistake, ignoring dividend growth. A stock yielding 2% that grows its dividend 10% per year will outpay a 6% static yield within 8 years. The third mistake, not checking balance sheet health. Companies carrying too much debt will prioritize debt payments over shareholder income in a downturn. Let's run the Concept Clinic Signal Score on dividend investing as a framework. Each factor rated 1 to 10 based on how well most investors apply it. Factors, core evidence, and notes business. Quality 7-10 focus on FCF consistency and payout ratio. Discipline separates real income from debt-funded. Yield. Valuation 60-10p FCF is more useful than PE for dividend stocks. Most investors never check this. Momentum 5-10 dividend. Growth rate as a momentum signal is underused. 5-year CAGR above 8% is historically strong. Risk for cheat 10 balance. Sheet risk is the number 1 cause of dividend cuts. Debt, EBITDA, above 3x is a red flag most ignore. Sentiment 610. High yield sentiment creates the trap. When yield looks too good, the market is often pricing in a cut. Total score 2850. Most investors apply dividend strategy with significant gaps, especially in risk assessment and momentum analysis. The dividend investing framework is sound, but most investors are applying only 2 of the 5 factors. That's why portfolios that look like income machines turn into traps. Here's the one-sentence takeaway. A reliable dividend is the result of a quality business, sustainable cash flow coverage, and a track record of growth, not a high yield on a screener. If you want to see the signal score applied to a specific dividend stock, Johnson & Johnson, Realty Income, or Altria, that video goes up. Subscribe so you don't miss it.